Recording in progress. Recording stopped.
Test 1, 2, 3. go ahead and bring the real assets.
Recording in progress.
Here, welcome everyone to the meeting. We'll just go ahead and start right off with the roll.
Yep. Thank you, Mr. Jones. This meeting is being conducted as a virtual meeting and in person. So we'll do a roll call of the trustees to confirm attendance. Mr. Jones?
Aye.
Me?
Present.
Aye. Thank you.
Oh.
Miss Martin, she is here, but she just stepped out.
Yeah.
Mr. Fay?
I'm here.
Okay. And Ms. Okay. Staff participating in the meeting include the following. CIO John Grable, Deputy Chief Investment Officer Jude Perez, Terry Harrobin, and we have Garrett. There you go.
Yeah.
Chief Investment Officer of IDR Investment Management. Trustees, please use your raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute their mic until you're ready to speak. And now we will proceed with the agenda.
All right, thank you. Next agenda item would be the approval of the minutes from the meeting last held on June 12th. Do I have any changes or a motion to approve the minutes as currently documented? Okay, may I get a second?
I can second.
Thank you.
Thank you.
Okay, Mr. Jones?
Aye.
Miss V?
Aye.
Miss Martin?
Aye.
Mr. Fay?
Aye.
Okay, the motion passes unanimously.
Super. Do we have any public comment at all?
Nope.
Hard to believe that we not have public comment for those assets, but from that sample, and then we have the pleasure of a report today. Our guest speaker, Garrett Zadolchik from IDR, and then our esteemed SIO Terry Harrobin, who incidentally, while I was in New York City, and I had the opportunity to socialize at a couple of real estate related holiday parties. Every time I mentioned LACERA, there was this anonymous Terry through there from a sundry group of people that were big fans of yours. So that was nice. But no, would you go ahead and introduce our speaker? And we're very anxious to have the presentation.
Thank you. Good morning, Chair Jones, trustees. I am Terry Harrobin, Senior Investment Officer. Pleased to be here today with you. We have invited IDR, one of LACERA's real estate managers, to present an educational session on the NFI Odyssey. And he's going to explain more about what that is. But essentially, that's our benchmark. And we thought it would be very helpful to provide this education on the components of that benchmark and answer any questions you might have about it. IDR manages the Core Property Index, which tracks that benchmark, and Garrett Zadolchik is the CIO of IDR. So no further ado, I'll hand it over to Garrett.
All right. Thank you.
Well, thank you. Chair Jones and trustees, really happy to be here. I'm going to be honest, though, I'm a little rusty with in person. It's been a long time. So I'm very excited to do this in person. Please ask questions. You know, in real estate, we tend to use a lot of acronyms and, you know, they mean nothing if you don't explain them. So hopefully we can do a little bit of that talking about the benchmark today. I think maybe if we go 2 slides, we'll talk about maybe the agenda real quick. There we go. So as Terry mentioned, I'm Garrett Zadolchik, the CIO of a fund that tracks the index. So we invest in all the constituents that we'll talk about later. But really our goal here today is to talk about what is this NFI Odyssey index, ODCE, we call Odyssey. So we'll talk about that. We'll talk about who publishes it. And then I thought we'd spend a few minutes talking about the drivers, like how does it perform? Why is it performing like it does? Because, you know, we are believers in benchmarks. It helps you understand how your portfolio could perform theoretically in a market net of fee. So we'll delve into that. And then lastly, I thought we spent a few minutes just talking about, you know, the market today, right? A lot of ups, a lot of downs, more downs lately, but we'll cover the rest of that. So, you know, we'll leave time for questions certainly, but if you have questions as we go, please ask. Maybe next page. So I mentioned, we'll talk about who issues this index. It's a group called NACREIF, National Council of Real Estate Investment Fiduciaries. NACREIF is a nonprofit. it was formed by its members because there was no benchmark or data about the private real estate market. And plans like yourself were saying, well, what should we think about for our benchmark? It's not available. They formed it over 40 years ago. And it provides not just the Odyssey index below, but other data and analytics on private real estate. So NCREIF Fund Index and Odyssey, it's basically open-ended diversified core equity funds. So as we go to the next page, if you think about indices broadly, right, fixed income, generally speaking, I know there's many other indices in fixed income and equities on the other side, but we generally use indices to try to give us a view of what the investable universe is and how a subset of that universe performed. Okay, so Barclays, Ag, everyone's probably heard of that in the fixed income world. On the other side, S&P 500, right? Everyone's heard of the S&P. It's 500 stocks, it's some of the biggest names globally. They're not the entire equity market, but they're meant to represent a bit of the equity market. So equities as a whole is about 50 trillion of investable world out there. Real estate, to give you a sense, there's about 20 plus trillion of real estate. Again, our index doesn't represent $20 trillion. It's in so many different hands. It's private, it's opaque, but it is meant to give you a sense, and we'll talk more about this, what core real estate should produce for you. Next page.
Hey, Garrett, real quick, in terms of the index on the other side of it, who most often is using the index? Is it mostly large institutional investors? Is it some mid-market? I mean, who's the audience that's looking to compare its performance most often to that index?
Yeah, great question. I would say it's twofold. On one hand, you have investors like yourself, so large institutional investors, and the NCREIF Odyssey Index is the most widely used index by those groups. And again, it's whether it's a state plan or a endowment foundation, they're generally using this as the base case. So like LACERA, for example, will say for core real estate, we use NCREIF Odyssey. If we go up the risk spectrum, we want a premium to that. So for non-core, I think it's 225 basis points, for example, right? But it's a basis to think about. And then on the other side, investment managers. Whether you're a core manager or not, you're looking at this benchmark saying, what is basically the risk premium I should be producing above this if I'm a non-core manager, or if I'm a core manager? They spend a lot of time thinking about this. You know, as you mentioned, Terry and we both actually came out of Cleveland, Ohio, believe it or not.
Yeah, there you go. Browns and Cavs.
There you go.
Yep.
You're welcome,
Mm-hmm.
I think.
Yeah.
But, you know, whether we're a core Odyssey manager or a non-core, we were always thinking about it. So again, as a base case, to think about this real estate benchmark compared to, you know, the S&P 500, for example, the investment universe is core real estate open-ended funds. We'll talk about what that means in a minute, you know, versus 500 stocks on the S&P. The index producer is a third party that's well respected in the industry, NCREIF on real estate and S&P Dow Jones. And the indices are capitalization weighted, meaning, and we hear a lot about it, right? If Apple has a market cap of over $1 trillion or maybe 2 trillion these days, you know, that's a much bigger weighting than a much smaller firm. Same here. Bigger funds have a bigger weighting in the index. Next page. And I think this is a big one. And notice there's only one thing on this page: transparency. This is the challenge of private markets overall, right? Public markets, you know, your CIO can go to the Bloomberg index, pull it down. Bloomberg tells you everything you want to know very simply and easily. In private markets, we don't have that luxury. So So you have to do a lot more work. You have to spend a lot more time compiling this information. Next page.
Here, another question for you. How much of a lag then as a consequence would the index have, given the amount of work that it takes to get to the private information? So when you're looking at that index, what's the lag that people think about?
Yeah, no, that's great. So to give you a real-time example, right? Third quarter data, which it should come out September 30th, right? This week basically is when final data sets are coming through to our systems.
Okay.
So we compiled everything and are sharing it with Terry and the team at LACERA this week on September 30. So it's more than 60, but less than 90 is really the, and so to be a manager, have a fund, one of these open-ended funds in the NCREIF Odyssey Index, there's inclusion criteria. There's many things, but these are the bigger ones I wanted to point out. First, not any manager can just go raise a fund and be in the index. They have to have managed through an entire market cycle. So it's mature managers. It's meant to be, larger, stable kind of groups that are managing capital. Have to be 95% plus exposure in the US, the underlying portfolio, the real estate. Has to be open-ended. We'll talk more about that in the private markets world, what open-ended means. But it has to have diversification as well. So no single sector funds. And there's some great single sector funds out there. Nothing wrong with it. It just doesn't qualify for this index. But it has to be diversified by property type, region. And one of the biggest things is less than 35% leverage. So these are meant to be very low levered, very stable investments. Next page. So here's what that index looks like. Here are the funds that make up the index. I mentioned there's 25 of them. And you'll notice, it's some of the biggest names, in investment management broadly, the Morgan Stanleys, JP Morgans, PGIMs, Prudentials of the world. And they all have different weights, but it is a broadly diversified pool of managers who are active, right? They're investing their portfolios to outperform this index. And investors are looking at this to say, how do I, select funds? How do I think about my exposures and what's important to me, right, in these different strategies? So these funds, next page, combined, if you look at it on a value weight basis, combined, here's their exposure: 34% industrial, 29% apartments, 17% office. We'll talk more about that in a minute. I know it's a big topic. Retail is 11%, and other, the non-traditional four sectors comprises 9%. And I am going to mention, I've been talking a lot about this with a lot of groups. These definitions and weightings are going to change slightly coming in 1Q. So your portfolio is not going to change, but the way they define a office building, whether it's office, traditional, or life science, is all going to be grouped together with subtypes. So these weightings are going to change slightly. Doesn't mean your portfolio changed. Don't be alarmed about it. But it's going to give the analytics teams more transparency and clarity on what each asset is really doing in the portfolio and how to define each asset.
Can I have a question?
Sure.
So first question is, it's good to have the property type exposure across all Odyssey, and then there's regional exposure. Is there a breakdown of which property types are exposed in the different regions?
Yes. So we could, and again, this is why they're also changing some of these definitions slightly, because the analytics teams want to be able, with data, abilities these days, they want to be able to drill down farther and farther and really kind of be able to define, how does New York City office perform relative to LA office or suburban, California office. So yes, absolutely. I would say like from office perspective, just high level to give you a sense, about 60% is suburban and 40% is CBD. So think of downtown LA or Manhattan.
Yeah, I'm just more thinking if there's a trend from office in CBDs or CBDs in the Midwest versus those in the West, like if that starts to flow from one place to another, that might be helpful for us to understand where the capital is going.
Absolutely. So that data I mentioned, talking about, sharing our data and our reporting with the LACERA staff, those are the kind of things we are doing in detail, right? To give you a sense, that's central business district CBD versus suburban was flipped pre-COVID.
Mm-hmm.
It was more 60%, 40 the other way. A lot of office has moved to the Sun Belt,
Mm-hmm.
and it's not just office, right? It's apartments and all these different sectors. Industrial, of the industrial, 30% is in California.
Mm-hmm.
Think about the ports and Port of Long Beach, right? It's a massively important, sector for not just real estate, but, the country, right?
And then one other quote. So, any questions?
Oh, no, you're fine.
All right. The other question I have is, so for core, we're trying to use it as an inflation hedge. We're trying to make sure that we have constant cash flows, and this is all going to be cap rate. Essentially, would lower the cap rate, the higher the valuation is in this weighting, right? And so the question for me is, do we have some type of indication of what's the attribution of where the cash is coming from, where we actually get not the returns, but the profits from to our funds, as opposed to just the fact that we know that industry has the lowest cap rate, and that's why it's the largest allocation?
Yes, we absolutely do. I think we have a little bit of a market update that we can talk about value changes and where those values have come. I'll be sure to add in the income component, if that's okay, kind of in context with that.
Perfect.
Awesome. Thank you.
All right. Thank you. Okay, go ahead, Garrett. Thank you.
All right. Let's move to the next page. So these funds, we call them component funds, or, they're like stocks, right? Each open-ended fund, as part of that index, I show you those slices. They're very different. So they can range in size from, 800 million of assets to 40 billion of assets. Think of the large cap, small cap. They utilize a range of leverage anywhere from 20 to 35% at any different point in time. They're moving their portfolios around. They can have a little bit of value creation or non-core exposure, but small, 0 to 10%. And then they can invest and are investing in those alternative other sectors. Again, the definitions are going to widen out a bit and give them more flexibility going forward. But today they're investing anywhere from 0 to 15% in that other category. Next page. So that's a bit of what that index is. I thought I'd now take the next step and talk a bit about what is driving the performance of the index. And then we'll end it with kind of where we are today and where we see it going forward. But next page is, and I know this is a single, busy chart, but think of this line as a measure of volatility. So each of those funds has a different return on a 1-year basis. This is showing the best performing fund and the worst performing fund over any time period. So if you notice, I use GFC, the Great Financial Crisis in 08, 09 as a benchmark, right? A big period of volatility. You see how that line spiked. A lot of volatility in return. Measures out a lot, really falls even below 1 standard deviation of volatility. So very low. And then obviously with COVID and the reset, we see a really high number. Part of the good news is this line is starting to come down, right? We are seeing a coalition around valuations, where real estate should be, where interest rates, may settle out. So, I think the good news is volatility is coming down. It's still fairly high, but it is coming down, and we think, that's a good sign. Secondly, I mentioned property types on the next page. Again, this is the same concept, best performing sectors. So think of industrial, high return lately versus, office, bad returns. Again, this is showing you that difference in performance. COVID, you see that huge spike where things like industrial did really well, office did really bad. But notice in the GFC that we didn't have that spike. What that's saying is the financial crisis was, again, a financial crisis. Everything did bad. It was all very correlated. It all kind of didn't matter what sector you owned. It mattered what buildings you owned. In this cycle, it's been much more about what sector of real estate did you own, and they've performed vastly differently. So again, to give you a sense of, not all cycles are the same, especially with real estate. But that volatility is coming down again, I think, as values are rationalized, and we'll show that on the next page. So these are time-weighted returns, meaning they're annualized. Over the last 5 years, if you owned industrial, you had a positive 13% return in the index, right? If you owned office, you had a negative 10% annualized return in the index. So you can see how big that difference of just owning the right sector really was. And remember, these are over 5 years. So in essence, take each of these numbers and kind of multiply it by 5. Not perfect math, but it gets you in the right direction to show you how big that chasm really is. Next page. So because of that, the underlying managers have been buying and selling and revaluing their portfolios. If you look at the orange line, the office exposure in the index, if you remember, I said it's 17% today. At one point it was 40% of a portfolio. Really big assets, really great if you have a lot of money to invest and put it to work, right? So there was a lot of office in the portfolio at one point. Given the trends, given the valuations, values, and exposure has come down significantly. And again, this is a nuance, but it's really important. This is gross value. So you can't just write your equity down to zero and have no office. This is gross value of your office, okay?
And Garrett, real quick, just for the benefit, and I know Trustee Me, I think, has been here through at least one of the full cycles that we had with Stepstone, if I'm not mistaken, in terms of, so part of our underperformance, and Terry, you can correct me here, just for the benefit of some continuity as the old guy on the deal, was that our underperformance over kind of the previous 5 to 10 period of time was mostly due to the overweighting of the retail apartment complexes that were in the previous slide and kind of an underweighting on the apartments, industrials. Is that a fair kind of summation of that?
With 85% of the portfolio in individual properties, we definitely reflected the fact that some of those properties performed better than others, and that was more difficult to peg to the benchmark, so it showed an underperformance to the benchmark. We definitely had differences than the benchmark, which came to show as a significant underperformance. And then some of those properties themselves just didn't perform as well.
Okay, thank you.
So we'll show the next page here to a bit of that point. This current bar all the way on the far right, if you see the blue and the green, it's basically saying what drove performance of the managers in the index. So what drove outperformance? Did they allocate to the right property types well? Did that drive the outperformance, or did they buy the right buildings within the sector? So, within office, did you buy a better building than the next guy? Or did you just underweight office better than the next guy? Okay. And so you see the blue, it's basically saying it didn't matter what you bought, as long as you got the weightings correct directionally, you got less office and more industrial.
Then you got the performance.
Then you outperformed. Okay. Now notice how big that blue is here. This is getting back to that other part of it. This has never happened in real estate before, the best we can tell. Okay. This is not something that has traditionally driven performance. It's traditionally been, did I buy the right asset? And did I, accomplish my business plan? So no matter how good you might be at execution with the asset over this past cycle, it's been really hard to overcome just the weighting impact. Okay. It's an opinion. I think this is going to matter a little less going forward now that values have been reset in this cycle, but that's an opinion.
So I have a question I'm more from the real estate side. So, yeah. The idea of the GFC was much more that there was financial issues, but in terms of how people actually lived on Main Street, their day-to-day lives, it didn't change that much, right? It was much more like, hey, do you have enough cash if you're a company to be able to pay your rent, because that's your first liabilities. Now we're talking about an actual real shift in how people live. And that's what's driving these sectors allocations. And so I guess my question to you is, do you think, or as you're looking through data, as you said, this is very strange. And is this something that you think will be continuing, that we will be changing how we live that much more in the future? Or do you think it will be more going back to the actual asset selection because will be a bit more stable?
Yeah, so I think that's a great question, right? And that's the investment thesis. I think you have to really coalesce around a view around that going forward. On one hand, I would tell you values have reset. So it's not. It's now, if I'm going to invest in office, I want a much higher cap rate, a much lower value for office and much higher income return. So there is a huge spread now between that no growth or low growth sector and industrial or apartments, in the right locations where you're saying, but I have a lot of growth, so I'll pay more for the building, but I have more growth over time. And that's where I think, that we're settling in in this cycle. So the question going forward, right, is that is the growth or the value right? In other words, on each of those sectors, or is it over, office is so difficult to invest in now. Maybe the values are too low, right? So there's some value, maybe I'm not, or maybe actually it's not low enough yet. And you should be in the apartment and industrial still. So, I think that is the really hard question to answer out of all these cycles. But it is definitely going to be, I don't think it's going back to historical, 5 to 15% selection, but I don't think it's going to stay at 75%.
Okay.
Garrett had made a point before that both investors and investment managers are using this data to determine how it will impact their portfolios, and then making changes as relevant in order to try to outperform the index.
Right.
That's the important part here. This is our benchmark. So those 25 funds are answering that question. And then we'll see that reflected in benchmark as we have with the weightings changing.
Mm-hmm.
And so that's where I think we focus on our view, but then really what we see is that the managers are having views on that, and it's definitely going to impact the composition of the benchmark.
That makes sense. I think the other thing, just as a thought, the final thought on this slide is more, as we interview more managers for the future, we're thinking of the value, we're thinking of the income, and there's human psychology at play that's going to go into a lot of this stuff. And so making sure that we have very good answers from what do you think people are going to be doing in the future and why. If we have that, then we'll capture a lot of at least on the blue stuff.
Yes.
Absolutely. So then this next page is saying basically, and it's hard to stay in weight. Okay. Unfortunately, about 80% of the value or of the weighting changes comes from value change, right? So office values going down, industrial going up, that changes your weightings without you doing anything.
Right.
So it's really, again, it's really important to have conviction around, do we want to start being in weight or not? Do we want to take these active overweights going into a cycle or not? Because once you're not investing new capital, your weightings are then change whether you like it or not, right? So it's tough. I mean, the managers, to Terry's point, the managers are watching this, and this is happening in their portfolios as well. So it's really important to pay attention to this, because you can't change it overnight, and it will change on you. Okay. Maybe one more slide here, I think, on this subject. Next slide. So tracking error. Tracking error is basically the measure of volatility. It's not measuring whether you did better or worse. It's just measuring how volatile was it to a benchmark. So it can be very good or very bad. In this case, you can see industrial, office, and retail have the highest tracking error to the benchmark. But in industrial's case, it's a good tracking error. It's outperforming. In office and retail, it's not. But I think the other important point is apartment. Good or bad, it really does follow the benchmark a lot more closely.
The board recognizes CIO John Rabel.
Good morning, trustees, members of the committee. Presentation's great thus far, and maybe we can replay it next month as we do the structure review for real estate, because what we're seeing in our portfolio is the magnitude of this tracking error, that we have a set portfolio, a lot of fixed assets, lumpy property types that don't move, or we're in the process of selling, but the benchmark has changed such that it's really impacting our adherence to guidelines in these different property types. So this is something that we're going to revisit these slides next month during the structure review, because it's something that is very pronounced in our portfolio.
Thank you.
So last slide maybe is just, and this is showing the underlying funds, like all indices, some stocks perform better or worse. This is showing you year over year, there is no one that outperforms every year, period. So, it's just saying, look, like all investing, you have to look to the long term. You can't just look at 1 year period and make decisions. It's really, especially in real estate. Next page. All right. So current market environment. Just a couple slides here on where values are from the peak, where we are today, and hopefully where we think we're going. And we do see some bright spots finally. Next page. So the blue lines here, the bars, are trailing 1 year net returns of the index, the 5 year trailing return, and then if you look at the inflection points at past cycles, the early 90s with the RTC distress, the GFC in 08-09, and good news, we're seeing another green bar here of an inflection point. And that is basically when we start seeing even the most modest positive quarterly return, it means we will likely see a 1 year trailing continue to get better and go positive within a year. Okay. So third quarter was I say modest, 0.02% net return, but it was positive. And what we saw were more than half the underlying funds had positive returns. Okay. And before that, only 7 had positive returns in 2Q. So we're seeing trends. And that's generally what we see in this slow moving asset class, is eventually a coalition around value and where things should be. Next page. So not to rehash, history too badly, but that net return still did see some depreciation. Here is the quarterly value change, so excluding income. And so I think this is the important point you kind of mentioned about income. Excluding income, values are still going down a bit in real estate. As a reference point, the GFC was basically 1 quarter less already. So it went through 2Q of 2024 on this slide. And then we saw positive appreciation again. So this cycle has been a little longer, or at least we are in a little longer cycle, but it hasn't been as steep. Values are down about 25% from peak. So it could arguably be a decent buying period. To give you a sense, that peak value is almost exactly when the equity market bottomed. So that correlation was good, I guess. But equity markets are up over 60% since that bottom. Okay. And I'll talk more about this, but that is going to be part of that bright spot is plans. Most plans we talked to today say they are underweight real estate, at least a bit. Capital is available for the right investments, for good investments. But a year ago, it was, don't talk to me. There is zero capital. I want my money back. That has changed. And the income does continue to come. So, investment return wise, about 1% income return is still coming off the portfolio. It is offsetting those negative value declines to some degree. So returns are down about 20%, values are down about 25%. Next page shows you again, I think we talked a lot about this, but the sector performance. So these are unlevered returns, but you can see the orange is an office. You can see how pronounced that office value decline has really been relative to the other sectors. But I think if you look at the last bar, office is what really continues to drive the value discussion in the index. The other sectors were positive this past quarter.
Here, quick question for you. So life sciences, prior to it being collapsed into in a future arrangement into office, it currently sits in industrial.
So, and again, this is why they're doing it. Life science a little bit sits in office and a little bit sits in other. There's about 2% overall exposure in life science in the index. So it's relatively small, but it will all go into office.
Okay.
So next page is really, again, talking about that income component here. Values are moving, but growth, so the NOI, in operating income of these assets continues to be strong. Investors are expecting with real estate, that inflation hedge from a value perspective, but unlike a bond, your interest and income can continue to go up. So I think this gives you a good sense of, COVID certainly caused an operating hole but it was a V-shaped recovery. Incomes continue to get better, notwithstanding the office conversation. And it's really being driven by that apartment and industrial sector. But even retail is starting to come back and has been worked out, if you will. So those three sectors are really driving value now.
Garrett, another question for you. So for housing separate from apartments, if I can use a distinction, is that included in the apartment category, that if people are aggregating, because you hear about private equity moving into houses and things of that nature, is it being lumped in and being called apartments? Is that where we would find it?
It is at the moment. Most of it is in apartment. There's a little bit in other as well. That's going to get reallocated. So the sector is going to become housing now, to your point, rather than apartment.
Right.
Although I will tell you in this index, there is really no single site like SFRs, housing for rent. That's a very nuanced sector. There's a lot of, good and bad about it, let's just say. These managers do not really have an interest in doing that. What they will do and what is in the index is purpose-built residential housing. So where they will work with a developer to have a small piece of a development purpose-built. But that's really what you own here.
Okay.
So operating fundamentals are good. Next page. Notwithstanding that, we are seeing a bit of a decline and seeing this run through the economy in terms of occupancy. Again, I think this is coming from a couple sectors. One, there's a lot of development leading up to the, value decline in apartment and industrial. So, that has slowed down. We think that'll get better. And then office certainly is really the key piece here where you're seeing some of that occupancy come off. But again, we think one, it's still well above historical average. I think it's showing a little softness in the economy, but we're not overly worried about it. All right, last piece. We talked about values. Again, low leverage can't be overstated in these parts of the cycle. It's great in up cycles, and down cycles is where you feel it. So this is the value change of each sector unlevered. So $100 office building is down 41%. Okay. So if you remember reading a lot of articles, downtown LA towers going back to the lenders. If you think about that, if you were 50% levered and your value is down 41%, you have less than 10% equity in your building now. Your 90+% equity has been written off. And you probably don't even have that. Okay. So, that's what we're reading about in the news. It's those higher levered, non-core, generally owners of office that wanted to play the upswing, got caught. They wrote it off. They either gave it back to the lender or are in the process of doing that. But that is how severe the office, issue is. And again, this is core, largely better quality, largely newer office. Imagine if you were in a lower quality and less good location, values are down significantly more.
Garrett, do you have a comment? We're is a part of the new plan that we got that was the outgrowth of the work we did with Stepstone. And I'm sure we'll see more of this in the structure review. Is we're waiting for the market to kind of clear, right? Because we're also trying to dispose of older assets that we can repurpose that money towards newer things that we want to get to. Do you have a comment at all about the kind of pretend and extend slowness? Everyone kind of hoping if I hold on to this, that the discount won't be nearly as low as it is today, tomorrow? Or, can you give us a little bit of a sense of?
Yeah, I think it will go both ways. So let me give you an example. And we're seeing this everywhere right now, whether it's New York or LA. So you're that owner that I mentioned that had a lot of leverage in a building. You're down 50+%, your equity's gone. The lender doesn't want really the building back.
Right.
You have no equity in it. And so, a tenant comes to you and says, hey, I actually want to be here. What happens? You go, well, I'm not writing the check. You go to the lender says, well, I'm not writing that check to build out all this space for them. They go, okay, well, then they go down the street to someone who has no leverage on their building, maybe. Values are down, but they still have a lot of equity left. And they go, yeah, I'll write that check for you, right, to come into my building. This is exactly what we saw with retail. There will be the chasm between have and have nots will get bigger and bigger until the issue is over. Okay. So I think you have to decide, again, we're not direct real estate people, but what we're seeing is the managers really decide, are we going to defend the building? Do we want to be in this long term? What's the return on equity of that dollar going forward? Is it good or not?
Right.
Or do we want to be in the extend and pretend camp and see what happens? But either way, we don't want to be in the middle because that's going to be the worst outcome.
Okay, thank you.
Right.
One other question. So since Odyssey was so much comprised of office and now much less, these folks are all buying it from each other at the market highs, right?
I'm sorry.
The different funds are buying it from each other. They were buying it from each other when the market was at its peak.
It's a relatively small market, these funds. Mm-hmm. So I would say it's pretty rare for them to buy and sell to each other.
Oh, okay. Then that takes away my other question.
Okay. There's REITs out there. That's a much bigger market. Like there's a lot of owners of real estate. And again, that's part of the challenge is it's very fragmented still. Last page, again, I'll skip over this. These are levered returns of the sectors just to give you a sense of even low leverage of what it does. But last page here on this presentation, if you go to the next page. So again, we use these terms in private real estate Q. Let me talk about what that is first and what open-ended means in these funds. It basically means on a quarterly basis, they use third parties to value their assets. There's a valuation process, and a value is struck on these portfolios at least quarterly. And that's how we derive these quarterly returns. We think it's a pretty robust and good process, although it's not perfect and it does lag, okay? As an investor, you can either go to them and say, hey, I want you to draw $100 from me, ideally at the end of this coming quarter at this new value. I want to invest at that value. Or if you're in the fund, you can say, with certain notice periods, hey, I want out. And at least in the lowest common denominator is really 90 days. You have to give them at least 90 days plus notice. Okay, so you can't sell a building in 90 days. And you can't necessarily buy a building in 90 days, right? So they have this queue concept where if they get too much money coming in, they put you in an entrance queue. That's the green line. That's very low. Okay, not a lot of people coming in today. The solid green. If you're in the fund and you want out, and they don't have any money coming in, they have to start selling assets. That takes time. They have to, sell those assets and then create the cash to then pay investors out. So that's this orange line. Okay, that's the investors that want out today. And so you can see it peaked right around 19% in this cycle of investors saying, I want out. Okay, that is really not all that dissimilar to the GFC where it peaked at 15%. Okay, and that's the dotted line. You'll get partial redemption. So it's not that they don't necessarily pay you anything, but they're not paying you what you want, right? Small percentages, maybe 5% of what you ask for or something like that. So after these cycles and after values are largely, written down, if you will, and we come to an equilibrium of, well, there's now investors saying, I like that value, and investors saying, well, that's when we see the Qs start to come down. So when we sent this in, again, that data lag, I put a dot there where I thought that line was going for 3Q. I can tell you it did go there. So it went down to 16%. And the dotted line is what happened in the GFC. So again, you can see this has been a little more drawn out. This has been a longer cycle, not necessarily as deep, but we are starting to look fairly similar in terms of how the Qs started getting paid down. Some investors are also saying, well, at this value, at this point, I don't want out. Like, I don't want to sell at the bottom. And then, the next part of the recovery, which again, isn't in the numbers, but I would tell you, we are starting to see again, is that green line start to come up a bit. So we are seeing capital come back to the space, limited, but some. Yeah. And that will really drive, in our view, the next part of the cycle in this future, 2025, where we see the recovery coming into focus. So I promise I'd end it on somewhat of a good note. We do see value stabilizing. We've been net buyers lately. And we think it's, 2025 is probably going to be, in hindsight, a good year compared to,
Oh, good. Thank you, Garrett. I think that was a good preamble to the structure review coming up. Any other questions from members? Trustee Mee?
I do have a comment. Thank you, Garrett. So speaking of 2025, what we're looking ahead, right? It's good to be optimistic, but maybe I'm a less optimistic person. And then I'm looking at the interest rate with the new administration coming in, tariffs, and then labor shortage. Those would all drive inflation up, right? And that unemployment rate would be low because the shortage will deportation. So I'm thinking there's no reason for rate cut out there. So how would that impact, the capital coming in that you might see, and then the whole cycle, with this macro environment?
So that's a great question. The first thing I can say, I'm so happy I'm not your CIO and having to navigate that going forward, because that's going to be really hard. He has a tough job ahead of him, because I think you're absolutely right. On the other hand, and not political, but we've also heard comments that, the Fed chair should be lowering rates, right, too. So I think there's a lot of forces coming to play here over 2025. Real estate managers have been notoriously bad at predicting interest rates. It's very hard. And I think, if you look at the forward curve, we're expecting one more rate cut, minor rate cut. Our view is it's going to basically stabilize. Okay. So if it stabilizes, we're seeing a decent spread to treasuries at the moment in cap rates and values. I don't think we are looking at a big rate decline, which will drive values up. I think we're saying values make sense today around these interest rates. And so we're really going to be looking at income and income growth as a driver of return, which, if you think about cap rates today at a, 4.7, so that's your going in 4.7 income return. You have NOI growth around 3, you're pushing 8 after fee, leverage isn't very accretive. You have no growth, you're at a 7 to 8, which is long-term historical average, right? But we're not in the camp that we're going to see double-digit returns.
I see. Thank you. One more minor comments about, I was reading the news that the hot sectors, maybe it's a more breakdown than what you have here, is the elderly housing seem to be very high demand for the baby boomer, the elderly, this generation really wealthy, and they can afford that kind of housing. And then the other one is the data centers. So would that kind of high demand and trending would affect your view of a location?
I think, again, it really, for the benchmark, what's interesting, and Garrett responded to this, is that the benchmark is recognizing that there is more interest in those sectors, and we're starting to see NCREIF be able to provide data specifically in their reporting on data centers, on senior housing. So we'll be able to track those investments, and our investment managers who are components of this index will also be tracking those as well. And then again, I think also making those decisions. Do those fit within a core portfolio? Do they meet the objective of providing largely income with some growth and a little bit of capital expansion, equity growth as well? And we'll be underwriting that as we're talking to those managers. So, yeah, but definitely we see those as up and coming.
Thank you.
Any other questions at all from my colleagues? Over there. Garrett, thank you very much. Terry, as well.
Thanks for having me.
Yeah, good preamble to the structure review coming up next month. So thank you. All right, next item on the agenda, items for staff review. Do we have any? There being none. Items for future agendas. There being none. Good of the order for the last committee meeting of the year. Trustee me. Do you have anything? Okay. Trustee Gatto, I know you just got here, but usually you're chock full of great wisdom and things through there. Got anything to share?
I don't sit on this committee, Mr. Chair.
Yeah,
I'm not allowed to speak.
Debbie, do you have anything for us? Okay, that was good. Trustee Payne? No. Just want to thank the real estate team for this. Terry, obviously our new leader, much anticipated. It's just good to get a handle on this as one of the asset classes. I think the board collectively has a very high interest in making sure we pay attention to and improve over the performance over the last kind of meaningful measurement period. So I just want to thank the staff complete for that. And then with that being said, let's adjourn, and then we should be able to get the regular meeting, BOI meeting, started at 9:05. So we'll re-adjourn at 9:05. Thank you very much.
Recording stopped.